Welcome back to Debating Your Dollars, where two financial advisors have two opinions with one goal in mind, helping you make sound financial decisions when it comes to your money. Today's topic is around risk tolerance, and should your risk tolerance matter? I have some opinions here. I don't know if folks are going to like them. I don't know if I'm right, because we check our clients' risk tolerance, how comfortable they are with risk. So clearly we're doing it because we want to know about how our clients feel about investing. However, I don't think risk tolerance should matter. I think what should matter is what's necessary to help you accomplish your goals. And we'll get into how you decipher that in a second. But what I liken it to is, if a doctor has to perform surgery, that doctor is not asking you, how do you feel about me doing this surgery? And if you don't feel good about it, he's not going to do it. But then you're going to get sicker or worse. So doctor is going to do the surgery, suggest the surgery, because it's going to help you in the long run. It's going to help you accomplish your goal, and that goal is probably to not be sick or to not die.
Yeah.
And that's what the doctor's objective is. Our objective is to help people accomplish what they would like to do financially, get from where they are to where they want to go. Sometimes assuming risk that is outside of your risk tolerance is going to help you get to your goal. Now, we're making an assumption that risk equates reward. We know that that's not always true, but let's just go with that assumption for right now, that the greater the risk, the greater the volatility potential, but also the greater reward potential. So, Nico, when we're putting a financial plan together for somebody, should risk tolerance matter?
I have to say yes.
Okay.
For a few reasons. I think that the risk tolerance questionnaire that, most advisors use does one thing really, really well, is that I might think a lot of money is $1,000.
Sure.
You may think a lot of money is $50,000. It immediately defines what a lot means, because we both know it. People have lost, like, say, $1,000, and they're like, well, my account's down a lot.
Right.
And then we've seen people,
that's a fair assessment, because listen, anything that helps us understand our clients better is a step in the right direction. So no, I can appreciate that.
That's my favorite part of it.
Okay.
And then my second favorite part is, in my opinion, the worst mistake a client can make is pulling their portfolio at a rock bottom market, like a 2008.
Yeah.
And that mistake often isn't weighed with the fact that if you don't take on this risk, you may not retire till 70.
Okay.
And I don't think they do. I think they need to consider, hey, this is my risk tolerance. They need to see what's more important to them. Are they going to pull their money at the bottom of the market if we go a step above their risk? Or would they rather stay down at this risk tolerance and outweigh that goal of, like, hey, you may have to work a little bit longer than you want to?
So the best portfolio for somebody is the one they're going to stick with, becomes more important than the desire to achieve the goal faster.
That's the question the client has to answer, in my opinion. And that's
because, listen, when you have a goal that you are falling short of, you only have a few options. You can either delay or change the goal, save more, or invest differently.
Yeah.
So if the budget doesn't allow them to save more, now they're between investing differently or changing the goal.
Yeah.
So I'm going to equate this. I'm a runner, have been a runner, trained to run marathons. if I have a goal of running a 3 hour and 30-minute marathon, I have to work at a certain pace. I have to do this certain amount of exercises. I need to do a certain kind of training. I have to be training at a certain speed. If I'm not willing to put myself through those paces and take the risk of feeling like crap for the day because I just ran hard in the morning, injury because I'm training harder than maybe my body's ready for me to train. If I am not willing to take that risk,
Yeah.
I've got to move from a 3:30 goal to a 4 hour goal.
Yeah.
So if I'm not willing to change that goal, I have to be willing to take that risk. Or when I toe the line on race day, I'm not going to get to that 3:30 goal. So when someone says, listen, I'm retiring at 62, come hell or high water, that is my last day of work,
Yeah.
then the risk tolerance doesn't matter.
I agree, because that's when you can't afford there. If you're set on that, like, what are you gonna do when you're out of money? You're out of money, like,
Right.
Like you know, and then it automatically becomes your fault. But you have to, you need to know what you own and why you own it. Like if it's true retirement assets, and I'm sitting across from a 20-year-old, and they just started investing, and they have $5,000 saved for, in say, like a Roth 401k, and they take a 50% loss, that might be the best thing that could ever happen to them, because now they're dollar cost averaging in
Back
every
in, right.
2 weeks at a 50% loss. So when it's someone younger, like, I'm encouraging them all the time, dial up that risk. You really won't notice the loss, especially your first couple years enrolled in a 401k. You're just going to be buying lower.
Yeah.
You know, I really think where people start to feel portfolio losses is right around when they get to $100,000, because the first time, you know, a 10% gain is 10,000. They're like, that's
right.
awesome. But a 20% loss, they just lost 20, and they're like, ooh,
Yeah.
what happened? You know, if it's at $10,000 and they get a 20% loss, like, they're probably not happy, but they're not uncomfortable yet. Yeah.
You know, the closer they get to the goal, the less likely they want to risk it. When that idea of risk changes, if you think of the automatic portfolios in 529s,
Yeah.
the closer the kid gets to 18 in college age, they start dialing back the risk, because one, the goal is closer. We know the liquidity date is closer, but folks do that in retirement.
They do it too soon.
I think I agree, because
Yeah.
you know, college, listen, that money is coming out and going to the institution.
Yeah,
It is going to the university. That money is no longer going to be yours. You're exchanging that growth, those dollars, for that degree.
Yeah.
In retirement, at 62, you may have, I mean, look at longevity. You may have a 40-year retirement after a 40-year career.
Yeah.
You don't have the capacity to not take risk. Maybe. Now, because I want to flip this on for something. If the goal is funded,
Yeah.
should you take the risk just because you can afford the losses? That's the is greed good?
Yeah, yeah.
Gordon Gekko. How many yachts can you jet ski behind? Question is, because you have the means, should you take the risk because the losses become less relevant to you than they do to someone who is just going to make their goal?
I'm a big fan and proponent of, you should always own some kind of stocks.
Okay.
In my opinion, even if you had all the money in the world, but didn't want to leave any estate, if you just Google it, like, what's the best way to pace inflation, it's going to say
Yeah, I mean, that's our best hedge against inflation.
You
right?
know, it helps protect against the unknown, because things are going to change. I think I was reading it was a New York Times article, I believe it was New York Times, where it showed, like, burgers and fries in 2025 is going to cost $16.11, and the article was basically talking about how when this came out, I think it was like 30 years ago, people were laughing at that, and now you go to Applebee's and you get burger and fries, it's probably about 16 bucks. You know, and so expenses people were laughing about are now a real thing.
Sure.
So you can't let the greed of, okay, I have this money, why should I even take any risk at
Yeah.
all because you don't know what the next 40 years. What if inflation's worse the next 40 years than it was?
It's the weather you can't predict when it comes to our money, right?
Cannot predict it. So you have to have a hedge against inflation at all times.
Agree.
That doesn't mean you need, if you have, say, $10 million, you're only spending $100,000 a year. That doesn't mean you need to have, 80% of it in stocks. But in my mind, you have to have a component there that is pacing inflation. The other half of risk tolerance, and I feel like we catch this the most in target dates, is in 401ks, your option will be like a life fund. It'll say like Fidelity. That's just an example. It's not knocking any specific company, but it would be say like a 401k provider 2065.
Yeah.
And what those funds do is basically say, this per person is going to retire in 2065, and they're going to automatically make a portfolio for that. In my opinion, those types of funds typically become too conservative too early.
Yeah.
The average market downturn, and when you look at some of the worst ones in histories, and you include the short ones too, is I think it's like 3.5 years. Mm-hmm. So if you're 5 years out from retirement, that's kind of when I would say, all right, maybe start adding, some different hedged options.
But you know why that is and why they do that? Because the 401k was designed with one purpose in mind.
Protect the business owner.
Well, protect it in accumulation.
Accumulation.
It's there for us to be able to accumulate assets to retire.
Yeah.
So to the 401k, data separation, data retirement, their job's done. They're not designed for distribution.
Yeah.
They're designed for accumulation. So that 2065 fund, their mission is complete. We got you through the accumulation phase.
Yeah.
Now, you and I say this all the time, the accumulation phase is easy.
Yeah.
That's simple. Save as much as you can, ignore the markets,
Yeah.
stay balanced, keep saving, get to that goal. Distribution phase, and this is why the 401k companies don't want to do it, because the distribution phase is hard.
Yeah.
There's just the decision fatigue that exists in the distribution phase is unimaginable to folks. The woman that we just spoke with, I can't believe what you have to know.
Yeah.
What you have to decide. It's unimaginable when you're in the accumulation phase. And those target date funds, it's complete. Mission complete.
Yeah.
They also get conservative, in my opinion, because their name's on it.
Yeah. Oh, yeah.
And they don't want to upset you close to retirement.
Yeah.
Because that mission's complete, that doesn't mean that company doesn't have a mechanism to help you in the distribution phase. So if you're not upset at them, you're more inclined to use their products, use their services when it comes time to the distribution phase. So they're being agreed too conservative, but not because it's what's in their client's best interest. It's what's in theirs.
Yeah, and I agree with that. There's too many people. You'll catch like 45 or 50-year-olds almost in a 60-40 type portfolio, which is almost like, in my mind, that's more of like a distribution portfolio, if anything.
Yeah.
Depending on the asset level, right? Always. But if this is their only retirement account, and this is where they're choosing to take risk, and they're having CDs at the bank where they consider that their conservative assets, and they don't even know it's getting conservative. They have no idea it's getting conservative. They set that thing when they were 20. They haven't looked at it since, and they don't even know what's happening in it. They're just trusting it, and it's getting more conservative, and it's limiting their growth in a lot of cases, especially when you still have a 15 or 20-year time horizon before you retire.
Right.
If you're 45, and your goal is to retire at 60, you still have 15 years. You should try to keep pacing inflation because things are going to cost more in 15 years
right.
too. So why dial back your best hedge against inflation right then and there?
Right.
Now,
You have to have that inflation hedge. And listen, inflation catches a bad rap. Inflation's good.
yeah.
Inflation's a sign of a healthy economy. Too much is not, but
There's standard
we're
inflation.
hoping
Yeah,
to see
it's-
inflation.
yeah.
That means things are moving in the direction that favors everybody.
Yeah. You want constant growth. You just have to be prepared for the consequences of that. And the consequence of that is you may have to be a little bit more
Yeah.
aggressive than you want to be. Now, I think the other half of this conversation too, when it comes to risk tolerance, is there's times where there can seem like there's deals in the market
Yeah.
besides equities too, and that takes
Yeah.
a lot of experience and really knowing what's going on in the economy, because I think any advisor, any investment person will tell you market timing is near impossible.
Right. It's
Near impossible. But if you just go back to a beginning of the year like this, equities stocks had a pretty good year,
right.
but a lot of bond funds had really good years as well, and they didn't even take on half the risk, right?
Right.
They were buying treasury bonds, mortgage bonds, whatever they're buying. They didn't take on half the risk, and they were getting about the same return, a little bit less, but way less risk compared to it. So you just need to keep that all in mind of when there's deals in the market and when there's not, and what's the hedge. I always tell people that in meetings is, you got to own equities. We know we're going to own equities. We just have to know what the appropriate hedge is right now based on the economy we're in, so that if equities have a bad year, you still have funds that are more stable and not moving with your equities. And that's where you have to trust us. But in my opinion, I don't think there's a portfolio without equities in my mind. There's
No,
not.
I agree. And again, I want to make sure that folks understand the risk exposure necessary for them to accomplish their goals.
Yeah.
And that, I think that is more important than their comfortability with that risk.
Yeah.
And if they're not comfortable with the risk that's necessary, how do we otherwise fund that? Is it delay or eliminate? Is it save more? To me, that has to be explained.
Yeah.
Not just, okay, your risk tolerance is moderate. Here's our moderate portfolio.
Yeah.
Because you're not helping. All you're doing is investing to capture a fee or commission.
Yeah.
But understanding the risk that's necessary to accomplish your goals is more vital than the risk that you're comfortable with.
I agree. And I think that happens a lot where, you're in the onboarding process. We get a risk score back and we're going in, we passed the discovery meeting, and now we're going in and doing a portfolio presentation. If they're more conservative on the risk tolerance form, we're going to show you what it looks like and the side effects of being conservative before. We're not just going to say, oh, this is your match. This is the this is the portfolio we're going to make for you. We're going to make you this conservative portfolio because you're conservative. We're going to say, here's the money that you're leaving on the table by staying in this conservative portfolio. Here's what you need to hit your goals. Where can we find that answer? Where's the common ground at? Are you willing to take a little more risk? Are you willing to dial up the risk because it chokes you up knowing you're not going to be able to retire at 62?
Sure.
So you need to find that common ground. I think that's the most likely outcome, especially working with us, is we're going to find that common ground.
Yeah.
What does a lot mean? What is the appropriate portfolio for you? This is your risk score, but this is what you need.
And what's the portfolio you're going to stick with in times of turbulent markets? Because we're going to have them.
Yeah.
That's a foregone conclusion. The market is going to go down.
Yeah.
I wish we knew when.
Yeah.
We knew when. We may not have to be working anymore.
Yeah.
But we don't know when. We don't know for how long. And that's always the tricky part is, well, shouldn't we get out? The market's down. Yeah, but what if today's the last day?
Yeah.
Is
You
always
made that move in April.
Right.
2 days later, you were punished
Right.
for it. Yeah.
So I can't say it enough. Understanding the risk exposure that's necessary to accomplish your goals is, to me, more important than understanding the risk exposure that your stomach can handle.
Yeah.
Because whose stomach can handle risk?
Yeah.
Who likes it?
Yeah, it makes you nervous. Like it should make you
It's
nervous.
the
if not, you're a
toll that
psychopath.
you pay to ride on the stock highway, though.
Yeah.
Risk is the toll you pay to ride on the stock highway. And nobody likes paying those turnpike tolls either.
No.
Especially in Pennsylvania. So, yes, I think risk is necessary. I I think risk tolerance understanding is necessary from both us understanding our clients' risk tolerance, but also our clients need to understand the risk that's necessary to help them accomplish their goals.
Absolutely.
Yeah.